So welcome everybody. It's really a great pleasure to be here in the 5th webinar of the MAIA project, focusing on the monetary aspects of ecosystem accounting. And ecosystem accounting, of course, there's a number of monetary ecosystem accounts dealing with valuation of ecosystem services, and also there's the monetary ecosystem asset account. And valuation of ecosystem services for accounting is not straightforward. It's not something which is trivial. So there has been a lot of discussion and debate in the last many years in the ecosystem accounting community on how to best do that valuation. And I think a lot of progress has been made in that period. So we really have come to a fairly good understanding of how we can value services and ecosystem assets for ecosystem accounting. And I think today is a great opportunity to share experiences, to discuss that progress, to present that progress. We got some wonderful speakers today that are very well informed on this topic. So I'm sure this is going to be a very interesting webinar. I should say first that the webinar will be recorded. So I hope that is okay for all of the participants. So if you ask a question, please be informed that it will be recorded. And the webinar will be made into a short video, which we will post on the MAIA website, maiaportal.eu, and so that is kind of a source of reference for people that want to learn more about valuation also in the near future. The speakers today are Bram Edens, to start with. Bram is working for UN Statistics Division based in New York. I've known Bram for many years, at least 10, I would say. And Bram is physical scientist by training, but moved into valuation as well. And Bram has been very closely involved in all the discussions on valuation in the ecosystem accounting community. He will give the first presentation. Then the second presentation will be given by Alejandro Caparrós from Spain, from CESIC in Madrid. And Alejandro has been working on ecosystem accounting before ecosystem accounting even existed, so that is quite an achievement. So Alejandro has been piloting and pioneering many of the valuation work that has later been used also in the ecosystem accounting approach. So it's wonderful that we'll also be able to learn from Alejandro today. Then the next presentation on value transfer will be Iona Grammatikopoulou. And Iona, please forgive me for not pronouncing your last name correctly. Iona is Greek, but working for Czech Globe, and is also an economist, also working in the MAIA project. Then David Barton will continue. David is working for NINA in Norway, the Norwegian Institute for Nature Research, I think. And David is an economist by training, and an environmental economist who will share also some of his work on benefit transfer in particular. The session will be moderated by Soile Oinonen from SEEA in Finland. Again, I'm not entirely sure about the pronunciation, but in any case, Soile has also been involved in work with in the MAIA project since the start, and Soile will be moderating the discussion. And well, I think that oh yeah, there's one more thing I should say, and that is that if you have a question for the moderator, for the participants, there's room for discussion after the presentations, and that will be moderated by Soile. And please then put your question in the chat box. So welcome everybody. I see that we're now at 61 participants. I see many people from Europe, but also people from outside of Europe. I spotted 2 people from the Philippines already, so a particular welcome to them as well. And I think we could start, so I hope you all really enjoy the webinar. I think, Bram, the floor is yours now.
Thank you for the invitation. It's my great pleasure to try to give an overview of the monetary ecosystem accounting book. So the outline of my presentation is as follows. First, I will discuss the purpose of valuation in SEEA ecosystem accounting. Then I will focus on the valuation approach taken, and then I go in a more depth of the various types of monetary ecosystem accounts that we distinguish. So starting with the monetary ecosystem service account, so the supply use tables, then the monetary asset account, Then the sequence of accounts. I will also mention the various complementary presentations, and then a short slide also on monetary indicators, and then I will conclude. So I think many of you will be familiar with this the conceptual framework that we have, but I thought it would be helpful just to remind ourselves. So basically what we're looking at, that we're conceiving of the environment consisting of a set of mutually exclusive ecosystem assets. That's sort of, I think the word is tessellate ecosystem accounting areas. They can be characterized by their extent, their size, but also by their condition. And these are all physical metrics. But then these ecosystems, they generate what we call final ecosystem services. And the notion here of final is really to emphasize that we're looking at the focus of measurement of ecosystem services that contribute to benefits used by the economy or society, which is depicted here at the right. This is not to say there are also what we call intermediate ecosystem services that are services that flow between ecosystem assets. And then, of course, these benefits may lead to individual and societal well-being, but that's not the focus of measurement. So we're really focusing, just like in the system of national accounts, on outputs and not on the outcomes. So another depiction here is, for instance, looking at a specific ecosystem asset, a forest. It can be characterized, as I was saying, by its extent, but also its conditions. So there's a range of variables, it's in soil depth here or biomass. And then that specific ecosystem asset can generate a bundle of ecosystem services. So more than one, such as water filtration. That can then lead to benefits such as clean water. And then ultimately, what is also quite important of the system is that we also show who the beneficiaries are, who the users are of that ecosystem services. And these services can be described in physical units, but also, and that's the topic of discussion here, of course, they can be valued in monetary terms. A key element here is, and that's why this distinction between services and benefits is important, that ecosystem services are defined in such a way in the ecosystem accounting approach as to avoid double counting. So we're really looking at ecosystem services contributions to benefits. Just to give an example, if we're looking at something like crops, or crops are already being transacted within the economy, that's really what we call S&A benefit. And then the ecosystem services is really what contributes, what the ecosystem contributes to that service. So what is the purpose of valuation in the SEEA? Well, the primary purpose is mainstreaming in economic planning and decision making. So the focus is here generally, and that's traditionally has also been the focus of the SEEA macroeconomic and national level. So what the SEEA tries to do is make these ecosystem services visible. And by so doing, also try to assess cost of degradation. And we have coined this also in our communications around the launch of the ecosystem accounts as #MakeNatureCount. So given that primary purpose, you can imagine that the key issue here is being consistent with the system of national accounts, and particularly with this notion of exchange value that I will discuss later. Another, I think, key element or purpose of accounting efforts is that it also allows you to use the accounts for all sorts of monitoring, such as deriving, for instance, SDG indicators, but more recently also in the context, for instance, of the post-2020 biodiversity framework. Then there are also a whole range of, I would say, secondary purposes of the ecosystem accounts that should benefit from the fact that, well, both accounts are what we call scalable, but also the fact that the ecosystem accounting approach is essentially spatial. So we're discussing accounts, but they're in most cases derived from underlying maps of information on extent, condition, but also ecosystem service in physical units. So for here you can think of all sorts of sectoral policies, let's say biodiversity, land use planning, to look at where, for instance, where protection efforts could focus on, depending on, for instance, the ecosystem service hotspots and so on, but also providing data that can be used to formulate all sorts of policy instruments, for instance, like compensation policies and so on. Anyway, the key message I think here is that given its primary purpose, there is and has been specifically in this revision process a strong focus on ensuring alignment and consistency with SNA, so System of National Accounts principles. So a key element there is the value concept that is underpinning the SNA, and that is exchange values. And these are defined as the values at which goods, services, labor, or assets are in fact exchanged or else could be exchanged for cash. So the key thing here is that the national accounts is what we call a transaction-based system. So basically we're looking at, for instance, all sorts of what we call institutional units. It could be households or companies that engage in all sorts of transactions, let's say purchases of goods and services and so on. And a key element of this what is technically a quadruple entry bookkeeping system is that supply needs to match the use. So we have one flow, and as a result of it, SNA accounts do not include consumer surplus, nor do they include externalities. Another key element of the SNA is that it's agnostic as to the market structure. So basically the accounts record economic transactions as they are, regardless of whether, let's say, markets are monopolistic or competitive and so on. Another key element of the national accounts is that the production boundary is legal. So, for instance, we would also impute in the national accounts, for instance, illegal production, hidden production, and so on. The key thing is that you need to make sure that you count everything that is included in the production boundary. So what is the relation here to welfare? Well, as the 2008 SNA makes very clear, GDP shouldn't be taken as a measure of welfare. However, and I think that's something that also came out through the revision process, it doesn't mean that there's no connection at all. For instance, the exchange value is also the marginal value of the unit, which is the well-being that that unit provides. And another important element here is that if you focus on sort of changes over time, which is one of the key things that accounts do, then changes and developments in exchange values approximate relative welfare changes. So, as I mentioned before, the SNA is agnostic as to market structure. So one could ask, why then not simply value all ecosystem service at value 0? That's according to the current institutions, right? Well, that's not entirely the case, because in the SNA, a key distinction is made between prices that are what we call economically significant or insignificant. So take an example of, for instance, something like education that in many countries is provided for free. The SNA doesn't then say, well, okay, it's valued at 0. No, it's saying, well, it has an economically insignificant price. That means that you're dealing here with a non-market producer, for instance, the government. And in such circumstances, you need to value these services at cost, for instance, by summing up the cost of, for instance, salaries of teachers and so on. A key difference here is that with the system of national accounts, that in the ecosystem accounts, we have deliberately extend the SNA production boundary as to recognize also ecosystem service as being generated by ecosystem assets. So basically this, given that we do that, this means that we need to estimate an exchange value using a suitable non-market valuation approach for these ecosystem services. For instance, what it would cost to produce or price such ecosystem services if they were to be marketed by, for instance, an ecosystem trustee. The key thing here to remember is that this is not, it's in fact very similar to what the national accounts do, for instance, when it comes to satellite accounts for household production. It's a very similar way, a similar approach that was taken here with the ecosystem accounts. Right, now turning towards the various types of monetary ecosystem accounts. Starting here with the monetary supply use tables, or the monetary ecosystem service accounts. So I didn't include an example here of that account because it's a pretty big table. But the idea being here is that the accounts describe on the supply side which ecosystem types and we follow here this IUCN Global Ecosystem Typology as international reference classification. For instance, wetlands, forest supply what ecosystem services, and there can be more than one. And at the same time, we have the use table, and remember, supply needs to match use. That shows which sort of institutional units, households, governments, economic sectors benefit from that specific service. And the key thing here is that the monetary supply use tables are consistent with the physical supply and use tables. So we conceive of value as a price times a quantity. So either we impute or estimate prices that we then multiply with the biophysically modeled quantities. So for instance, in case of carbon storage, carbon retention, you have, let's say, a map of where that is happening in the landscape, and then you apply with a suitable price. Or the other way around is that if you would have a value, for instance, based on value transfer, then you can sort of decompose that into suitable prices and quantities. The key thing here that ideally is that valuation is done in a spatially explicit sense. So what is the preference order for ecosystem service valuation? Well, first of all, we would prefer methods where the price for the ecosystem service is directly observable. So for instance, with an example of stumpage prices for timber. Second would be sort of proxy prices or prices from proxy markets. So you could think of, if you think of, let's say, collection, subsistence collection of non-timber wood products, for instance, mushrooms or so, you could take a price of a nearby market, for instance. Third would be methods where the price for the ecosystem service is embodied in a market transaction. So this is the situation in case of what I described before as SNA benefits, for instance, these crops. They are already transacted, so what you can apply that here is methods such as resource rent or residual approaches to sort of separately identify the contribution to that market exchange provided by the ecosystem. Fourth would be methods where the price for the ecosystem service is based on revealed expenditures for related goods and services. So an example would here be, for instance, a travel cost approach. And then fifth are methods where the price for the ecosystem service is based on expected expenditures or markets. So these could, for instance, be methods such as replacement cost approaches. So that was, I think, the first type of account. So that's a flow account, valuing ecosystem services. The next account is the monetary ecosystem asset account. And the key idea here is that, well, assuming that there are no market prices for ecosystems, which generally is not the case, we can value these assets applying the net present value of the services they provide. And the key thing here is that each of these assets can provide multiple services, so we sum over all the services. And of course, we would need to think of suitable discounting rates and also ways of projecting these ecosystem service flows going forward. So in theory, it's sort of, I think, easy, but in practice, this may be not so easy. And then I want to just show the account here directly. So this is what the monetary ecosystem asset account looks like. I'm not sure it's visible enough, but let me describe it. So basically what you have in all what we call capital accounts, you have opening values and closing values. So you could apply your net present value calculation at the beginning of the accounting period, beginning of the year and at the end of the year. And what the account then does is sort of decompose these elements, this change in value, into what is called ecosystem enhancement and ecosystem degradation. So that's the first two row elements. And basically that is rooted in the physical the condition account. So changes in value due to improvements in the physical condition of the ecosystem asset would be recorded as enhancement. Then we have a separate entries for what we call ecosystem conversions. So that could be an ecosystem asset changing, let's say, from forest to urban. So these changes in values for that ecosystem accounting area, because that's what we compile the account for, would be recorded here as ecosystem conversions. We have a separate row in line with national accounts conventions for other changes in volume, for instance, in case of catastrophic losses or seizures of land. Then quite important, a row element for revaluation. So that's really changes in asset value that are caused by changes in the level of prices. So that's in a nutshell what the monetary ecosystem asset account does. And then this information can be, because we are consistent with the system of national accounts, can be integrated with and to form what is called an extended SNA balance sheet. Again, it will be difficult to read, but basically what you would have there is in the SNA, you would have all sorts of produced assets. So you could think of here buildings or machinery, etc. Then we have, and also there are financial assets and so on, non-produced assets. But the key thing here is that we have this category of environmental assets / ecosystems, where we have come up with, I think, a comprehensive and consistent way of also depicting environmental assets as defined in the SEEA Central Framework. So for instance, these are sort of nested or subsumed under the ecosystem assets that they apply to. So you would have, let's say, an ecosystem asset of a forest, of which part of it would be the value of standing timber. The key element here is also that land is kept separate, as land is conceived in the SEEA Central Framework as the mere provisioning of space, which we do not consider as an ecosystem service. And finally, another, I think, interesting element is that we now also recognize the atmosphere as an asset. And that's, I think, a key step forward also compared to the SNA and the SEEA Central Framework. So that was the second block. Third one is what we call a sequence of accounts. And basically what it does is, so in the system of national accounts, you have this whole sequence where you start with current accounts, such as the production accounts, giving GDP, the income account, giving you national income, distribution of income, etc. You have capital accounts, and then you end up with the balance sheet that basically provides your total wealth of your country, right? So basically what we do here in the sequences of accounts is that we make all sorts of adjustments for these ecosystem services. So we essentially raise output of the economy. We also raise value added of the economy to the extent that the ecosystem services contribute to non-SNA benefits. Another key element here is that, and that there's a row here that is called the degradation adjusted net value added, is that this estimate of degradation that I just showed in the monetary asset account can be shown here and basically correct for the using up of natural capital of ecosystems. So those are some of the key adjustments made, and all the way to the bottom, you would find then also your value of natural capital, sort of your comprehensive measure of wealth, adjusted net savings, and so on. So this is basically what's possible to do. Fourth block is what we have called complementary presentations. So the focus of measurement is on these final ecosystem services. In principle, exclude externalities and also ecosystem disservices. However, in this section E, we do show that it's possible, if you'd like, to have alternative assumptions about institutions, and that would allow you to show also externalities or ecosystem disservices. Also, all sorts of alternative measures of income, wealth, and degradation. So the default recording is what we call a cost-borne approach, but it's also possible to, for instance, allocate polluter or degradation cost to the institutional units causing the pollution. It's possible also to have representations that look at the restoration cost and so forth. The key, I think, element that I wanted to mention here is this, what we call the bridge table between accounting and welfare value of ecosystem services. The focus of the SEEA is very much on instrumental values, on use values. So there will be, and as I mentioned before, we exclude the consumer surplus. So there will be differences with people applying, let's say, inclusive wealth or TEV kind of approach to measure the environment. And this bridge table gives you an overview of how you can go from one of these value perspectives to the other. And I think that's quite helpful because it can also show, I think, to policymakers, for instance, the current way, the current institutions for which an ecosystem is managed lead you perhaps to a certain exchange value, which may be, let's say, a lot less from the value that society would place on it from a welfare perspective. So I think that sort of spread and difference can provide also relevant information. Then quickly, there's also a lot of or there's a chapter 14 on indicators that lists all sorts of indicators, also coming from the extent and condition accounts, of course. But I wanted to highlight a few of the indicators that can be derived from the accounts. One of them is GEP, or gross ecosystem product, which is basically the sum of all the final ecosystem services that are being supplied in ecosystem accounting areas. This indicator is now also being discussed and proposed in the post-2020 biodiversity framework. But there are also all sorts of combined presentations that you can do, for instance, looking at ecosystem service values per hectare, but also looking at, for instance, what is it, the value at risk or the dependency of economic activities on nature. So with that, I would like to conclude. So there is in the revised SEEA a clear focus on consistency with SNA principles in line with its main purpose. What I didn't detail here, but I think it's important to mention, is that for instance, in chapter 2, there is also, I think, a clear articulation of the value stance that SEEA ecosystem accounting takes to situate also what the accounting does in relation to other more broader value frameworks, such as IPBES and so on. What we have also made quite clear in the revised handbook, that there is always a need for careful interpretation when doing monetary valuation. We're not aiming or claiming to sort of come up with the value of nature. Another thing is that where possible, we recommend to present physical and monetary information data in parallel. And finally, as I mentioned here, there's all sorts of, so I presented here on these core ecosystem accounts, but there are all sorts of other complementary alternative presentations that are possible due to the integrated nature of the accounts. Okay, that concludes my presentation. Thanks, everybody.
Thank you, Bram. We have one question to you. So the question goes like this. There is a lot of interest in the economic value of biodiversity, for example, the recent descriptor review, but biodiversity is not an ecosystem service. What's the SEEA view on this? Can you elaborate this?
Sorry, I was a little bit distracted to stop sharing. Sorry, can you repeat once again?
What is the ecosystem accounting view on biodiversity? It's not the ecosystem service per se, so how perhaps you can explain the biodiversity accounting.
Yeah, sure. No, I think that's quite important. So we have actually in chapter 13 we have also a section. We have various sections. So one is, for instance, on climate change, but there's also one on biodiversity and accounting for biodiversity. So I think generally we see that the ecosystem accounts can provide all sorts of relevant information, and examples there that are provided there is, for instance, species account. That can be compiled. I think sort of there are multiple connections between our. Yes.
It was my question. It's not the question if we can accommodate biodiversity in the accounts, because we do. But my question is on a direct economic valuation of biodiversity, because there is a lot of interest in that. So a lot of people want to think that it's also possible to give an economic valuation of biodiversity as such. And so my question is that consistent with the SEEA guidelines or not? What do you think about that?
Yeah, well, I think that of course, that's a little bit a tricky question. So I know that some work has been done by, for instance, by the IMF, where they value specific, species, right, like whales and so on. So that's I think something that is I think a little bit different from what we have been doing, because we have been really focusing on valuing ecosystem assets. I think there is a sense, if you sort of equate in a certain way biodiversity with the sum of natural capital, that of course you get with what we're doing in a way at least a partial value. But I think a key distinction is this notion of non-use values and things that well, we have had a lot of discussions on how to go about valuing all sorts of non-use and existence and values and so on. And I think that's one topic what we currently have on the research agenda. So I'm not saying it's not possible, but I don't think we are currently there in providing specific recommendations on how to go about it.
Okay. Yeah. Thanks. Yeah.
Any other questions? I don't see any on the chat box. So then I think we can continue with our next presentation and continue discussions later.
Okay, so I will talk a bit more on monetary evaluation this year. I'm going to focus on one of the parts, or elaborate one of the parts that Bram just sketched. And so we're going to try to value ecosystem services in monetary terms, seeing ecosystem service as the contribution in monetary terms of nature. So the contribution of nature to the ecosystem services that has been produced. We, as Bram just said, it's very important to make sure that we have consistency with the exchange values in national accounts. They're one of the key goals that we'll have. We'll be excluding consumer surplus in all the methods that discussed, as just was proposed by Bram. And what's also important, we will have estimates of output and ideally of intermediate consumption, but not so much in this year. So, but it's important that irrespective of the method used, man-made inputs need to be deducted to arrive at the ecosystem service, defined basically as a resource rent. So we'll have the output, basically to be more precise, the consumption of final products. We have to take out intermediate consumption. We have to take out compensation of employees, other taxes, take out our taxes on production, add subsidies on production, take out consumption of fixed capital, take out returns to produce assets, take out labor and self-employed persons. And then we will have the resource rent, which is basically the ecosystem service that we are looking for. So it is only the contribution of nature to the output that we have been producing, and taking out all the man-made inputs. Basically, that's the idea. So that's what we're looking for in the following. And for that, they have proposed us a set of values of methods, and they have already been enumerated by Bram before. So the first thing, we want an exchange value. If we are able to find an exchange value that's already net of all these costs, then it's directly observable. That's obviously the preferred method. If we have a market for this ecosystem service, that's the best situation. If we don't have a market for itself, we can go to a similar market which exists close by. So maybe for mushrooms picking, we don't have a market in this forest, or we have a market elsewhere, we can use this data. So when we have market values, because we're looking for exchange values, as Bram said before, we're looking for a transaction. If we can observe it, that's perfect, then we are done. So there are other methods for the ecosystem service now is embodied in the market transaction, but it's not anymore the full market transaction. The full market transaction is not about the ecosystem service, about something larger. Here we have the residual value and resource methods that I already sketched a little bit before. So basically you have to take out everything which is man-made input, because we have something which is not, the ecosystem service itself was not traded. This is in general quite often the case. Productivity change method, here we're going to consider ecosystem service as an input to the production function and look at marginal changes. Similar in concept, if you want, to the previous one, we have the ecosystem service as one of the inputs, and we have to take out all the other inputs, all the man-made inputs, basically. Basically, what we're going to get here is we're going to reallocate things that are already in the SNA, because this transaction already took place. So these values are already in the GDP. Basically, what we're going to do is say how much was the contribution of nature to that what has been already included in GDP. The same can be done with the hedonic price method. But here, this method in general in environmental economics, it's applied to obtain consumer surplus or Hicksian variation. So here we have to change it a little bit and simply use it to decompose the price. So the price of a house, we can see how much was the contribution of nature to this price of the house, because the house is more expensive because it has a very nice environment surrounding in terms of nature. So that's what we want to do, decompose the price, not derive the consumer surplus. If you go into an environmental economics manual, you will see, and you look at hedonic price method, you will see how to use it to derive a Hicksian variation or consumer surplus. That's not what you want to do. What you want to do is simply decompose the price. So other methods where the price of the ecosystem service is based on revealed expenditures for related goods and services, like this was mentioned by Bram. We have the averting behavior method, where you say, well, basically people are paying to avoid the damage. They're paying to avoid. And this is kind of the minimum that they're protecting themselves from environmental impact. What you're protecting, you're saying, okay, the typhoon, that's the minimum that you are willing to pay to avoid this damage. The travel cost method, here we're going to go more into detail afterwards, is a little bit, to some extent, confusing again, like could happen with the hedonic price method, because the travel cost method is actually usually designed to obtain a consumer surplus, acceleration. Here, if you obtain a real consumer surplus, it is not an exchange method, value, so you should not use it. You can use it together with what I will explain actually with the simulated exchange value, or you can use the information on this travel cost method to calculate what is consumption expenditures, so what people really expended to go to the place. But in the travel cost method, you have a next step, which is now estimate the demand and then integrate under the demand to obtain the consumer surplus. That is not what you want to do. So either you use the travel cost method as an input for the simulated exchange value that we'll describe below, or you simply focus on the consumption expenditures. This is a little bit confusing, I think, at least it may be, is when I'm going to focus most of the rest of the presentation. Then we have some other methods based on hypothetical expenditures on markets, where we have replacement costs, where basically what you would need to pay to replace the ecosystem service by something different. So you have an ecosystem service where it's providing you benefits, and you would need to replace it by something else if it disappeared. So the same as the avoided damage cost is a similar idea. How much is the cost of the damage that would occur due to the loss of this ecosystem service? And these are all methods which are basically based on cost, and it's not going to be the main focus of my presentation, but they're all within the current SEEA. So they're all considered to be an exchange value, and they can be considered an exchange value, but it's important that you need to show in most of them that the willingness to pay actually exists. It is not enough to assume it. So basically the idea is, okay, yes, we could have the replacement cost, but it can be considered an exchange value only if this disappears, this ecosystem service, it would really come and implement, so really replace it for something different. This is not always the case, and sometimes these costs can be huge, and then society would not do it. So you really would need to show that there's a willingness to pay to do it properly. In many studies, it is simply assumed. This is not ideal. So, okay, could be done, of course, but it's not ideal. So really, to have an exchange value, one of the conditions that we should have is that showing that there's a real willingness to pay, to actually pay for this replacement cost or for the other methods that I just mentioned. But what I said was I'm going to focus most of my presentation here is to distinguish in the travel cost method, this consumption expenditure method, and the related simulated exchange value method. This is what's going to explain now, because there are different methods and they're a little bit confusing in some instances. But in any case, before I go into that, I was just to say that, I mean, there's still some controversies around some of the methods, and there seems some refinements to be done. But in general, I would say we have reached quite a general consensus that these methods can be used, in some of them at least, to obtain exchange values for the ecosystem services, that we should use the net present value to value assets, as Bram just said, or we could use the hedonic method for assets as well. It would also be accepted in general. So there are some methods which are quite clearly accepted. Others are slightly controversial, but I think that over the different versions that the SEEA has had, now we have a almost general consensus, absolutely not a general. There's still controversy, of course. There's, of course, some discussion going on the robustness of the methods and data availability and so on. But also many of the discussions are more general critiques to monetary evaluation, not to ecosystem accounting itself. So they're very general critiques that you cannot solve for ecosystem accounting, the same that you cannot solve them for monetary evaluation. So as I said, what I'm going to focus now is not on the most acceptable methods, and some of them more challenges, some of them more complex if you want, showing that they can be used this afternoon or later this afternoon. I will present some application in Andalusia that we did of all these methods, but now I'm just going to present them in theory. So as I said, travel cost method, consumption expenditure, stated preference, and simulated exchange value method. So what I'm going to talk about. So the travel cost method, the stated preferences, they all estimate your demand function. Now, with these demand functions, you can do several things. The important thing, if you integrate over all the demand function, then you obtain basically a consumer surplus. Technically it can be a Higgsien variation, but that we can forget. So if you integrate over all, so you look all the area under the demand function, you obtain a consumer surplus, which is not what we want because it would not be an exchange value. Then what you can do is and that's what the consumption expenditure method says, well, I will focus only what people really spend, not on the part that they could have spent hypothetically. What is the demand, the maximum that you would have been willing to pay. Demand is always the maximum that you would have been willing to pay. For example, if we're focusing on recreational area, to be more precise, what's the maximum that you would have been willing to pay to get a particular recreational area? That's one method you can use. And the other one would be the simulated exchange value method, which can be used once you have the demand obtained either with the travel cost method or with stated preference method. And then what you're trying to do is see essentially what is the amount that you could charge if it would be traded for real this market. So you set up yourself. It was Bram said before already in the SNA actually, you have that is exchange values that are traded or else could be exchanged for cash. So you're really saying, okay, it could be exchanges. So when you go to a national park, you're not paying, but in Europe at least, but you could pay for it. So let's use all the information that we have, the demand, the supply function, the market structure that is more likely, which in some cases will be monopolistic competition, but otherwise will be perfect competition. So you basically do the whole thing and try to simulate what the market price would be. So that's all maybe a little bit confusing. Let's use an example of a very, very simple travel cost method and see how you would apply all these methods. So now they have this zone A, zone B, zone C, and zone D. In the middle of the green area is a zonal travel cost method. So this is zone A is where you have a national park, let's say. So the further away you are, A, B, C, D, the travel cost increase. Population, there is a city in each of them, same population to make it simple. And then, well, we have more visitors, of course, from area A, because it's closer. We have only 15,000 from there. We have 9,000 coming from area B, 6,000 coming from area C, and none is coming from area D. Altogether, we have 30,000 visitors. So that's the situation that we have. And we use this information to apply the travel cost method or the other methods. This is a very basic zonal travel cost method. So how would you play this information? So you would say, okay, if the price is 6 euros, I have 15,000 visitors. If the price is 10 euros, I have 9,000 visitors out of a population of 2,500. If the price would be 15 euros, I would only have 6,000 visitors. And if the price is 20 euros, I have no visitors at all. So with this information, basically, you do a regression. Of course, this is a very, very simple one here. I mean, it's not fancy at all. You can do it much more fancy. But basically, you're doing a regression, and now you have a demand function. That's how you estimate a demand function. You have to take into account the different zones. I simplified extremely because I have all the same number of visitors in each of these areas. Otherwise, it's a little bit more complex. But basically, at the end, you come up with a demand function. So now you can say, okay, the blue area is what people are really playing. Now let's focus on the people coming from area A, those paying 6 euros. So they are paying only 6 euros. But the assumption that you make if you do a travel cost method, is that those people coming from this area A, some of them would have been willing to pay 15 euros. Because I know that from area C, some people came and paid 15 euros. I assume it's the same type of people. So I say those in area A, fair enough, they only had to pay 6, but some of them would have been willing to pay 15. That's how you obtain a demand. So the maximum that people are willing to pay, and you obtain this information from the data from other places. So now, as I say, we are focusing on people from area A. They only paid 6, so the consumption expenditures are only 6 times the 15,000 that came. The consumer surplus, on the contrary, is the shaded green area. Shaded green area is not part of national accounts, or should not be part of ecosystem accounting either. The blue area is already included in GDP. It is included as what you pay for your train ticket, what you paid for your gasoline, etc. Of course, I could say that this part of the expenditures, actually you did it because you wanted to have this recreational benefit. So this I could allocate to nature, but this is actually already in GDP. It's just reallocating. And now what I could also say is, okay, if I would be the owner of this national park and I would charge a price, what price would I charge? Well, they are spending in something else, on gasoline, for example, or train tickets. I will pay an entrance, so that would be the simulated exchange value. what is the maximum that it could make people pay to have a single price. Let's make it simple. You have a single price. Then let's say in this simulation with the numbers that they came up, I think it was 6.5 was the best that you would have as an entrance fee. So this is the simulated exchange value. There is a transaction taking place right now, but people are not paying because people are coming to visit the national park, but they're not paying. It's what Bram said before, but it can be something significant and they would be willing to pay. So then if we simulate this exchange and say how much would be the price that they would be willing to pay, the best simulation that we can do in this particular case is this green area. So this is going to be smaller than the consumer surplus by definition, because it's part of the area under the demand. And it's going to be different, of course, with the blue area, which are not related. For the numbers that I showed before, so the numbers that I showed you before are here on top. Again, the very simple numbers that they came up, you obtain these values from area A, from area B, area C. So you have a consumer surplus. The first column would be 180,000. The last column is simulated exchange value, which, as I said, by definition is less than the consumer surplus. If it would be actually linear, well, your assumption would be half, but usually that's not necessary. Here is a little bit less than half. On the other hand, the blue area is completely unrelated to the consumer surplus and the simulated exchange value because it's what is already paid. Here, the particular numbers that they use is actually larger than the consumer surplus. But this is not necessary, it can also be smaller. It's just completely unrelated because, as we said here, one is what you paid already, the blue area. The other one is what you would be willing to pay, of how you obtain a demand, the maximum that you would be willing to pay, the CEF, the maximum that we think that with a realistic market structure, you could actually make people pay. So that's what would be with those methods. So these methods can also be applied, the same idea can be applied not only to the travel cost method, the simulated exchange value that I just mentioned, you could also apply it to using contingent evaluation or stated preferences, like contingent evaluation or choice experiments. So in this application in Andalusia that we have here, we applied it to recreational sites in Andalusia. There were 10 areas, iconic recreational sites. There we assume monopolistic competition in each of them, but that's just an example. You could have other areas where this is different. We use the contingent evaluation. Costs in this particular case are assumed to be constant, but we took them account, but they were assumed to be constant, and then maximization is very simple. We obtain site-specific demand functions for each of these areas, and then, of course, it's very important to assess the institutional feasibility. Here, it was absolutely feasible to implement this payment, and that's what we obtained. We did the calculations for what would be the price that you would pay. People would maximize the revenue, maximize the benefit for the environment, and while the median was a good approximation in this particular case. So here, what we did, if you look at the numbers here, what is important is that what you're obtaining here is something which is, well, first, the median is a good approximation. That means that you can make a simple method. So you can simplify it from doing the monopolistic competition in a real optimization, taking everything into account. You can simplify by doing median instead of the whole thing, multiplied by 50% of the population. It's a good approximation. But what is more important is that this method is much more robust than consumer surplus would be and a Higgsien variation would be. This method is more robust because you are focusing on the intermediate part of the demand function. You're not on the extremes. Consumer surplus comes to extreme. So, but before there was a question about biodiversity. So we have tried to do the same thing for biodiversity. This is also published already in 2019 within this general method that I will describe this afternoon better. But in principle, you could also make a payment for ecosystem service for biodiversity. You could simulate what people would be willing to pay for that. In this particular application, what we did is, okay, we have landscape and some threatened biodiversity associated, and we present them with a program where they're willing to pay for protecting the number of species which are threatened do not increase, so that you have the same number of threatened species that they continue in the same status than they are currently, and also that the landscape, the forest continues in the same status. And then instead of estimating for that a Higgsien variation, which is what you typically do with a choice experiment, what we try to do is see how much you can make people pay for the payment for ecosystem service. So if you would be marketing a payment for ecosystem services where what you are proposing is to maintain the current status, then the maximum revenue that you could obtain is shown in this graph on the right. It is a simulation, many simulations, because it's a mixed logic model what you do. But basically what it shows that, of course, there is a different prices, more or less people will accept to pay. So if you increase a lot the price, then you will have only a few people accepting, so that it's not the optimal. So the optimal would be up here. So basically you're again doing simply an optimization problem where you're trying to maximize the revenues that you could hypothetically obtain for this payment for ecosystem service. So that would be potentially one way of bringing biodiversity into, in monetary terms, answering the question that was done before to Bram. So what I said before, there's some controversies. I would say that for some methods there's some controversy, but we are more or less in agreement what we can do. For assets, there is less controversy. There's basically either you net present value or you do a hedonic method. In the application that I will discuss later this afternoon, we do net present value, but absolutely hedonic methods for us is perfectly fine. There's some methods on the some very general critiques, but I think that even the more challenging methods, that's what the ones I focused here to some extent, can provide meaningful and useful results. And then what would be maybe a first step? What I would do if I would be in a country where I would like to do one of the first steps, where recreation is a good place to go start, biodiversity is much tougher. But here you can use this travel cost data to obtain these consumer expenditures that you can do. Once you have those, you can estimate the demand very easily using the travel cost method. And once you have the demand, you can estimate the simulated exchange value, which you can, I think, I'm convinced, you can include in the accounts. You should not the consumer surplus, but it's basically the same method. And potentially you could do, if you have doing a survey, you could do the same thing with the contingent relation or a choice experiment. But using travel cost data and travel cost method as an input for SEF or itself as an input for consumer expenditures, as I said before, I think is a very good first approach. So this is basically what I wanted to say. So if there are any questions, I'm more than happy to try to answer them.
First of all, I would like to thank you for the invitation. And also say to Lars that he pronounced my surname quite okay, so no worries in this respect. In this presentation, I will have a short introduction on the value transfer method under the SEEA, especially under the SEEA context and under the context of ecosystem accounts. Here's an outline of the presentation. First, I will say what is the method about in general terms, but also under the ecosystem accounting context. Then I will show you what are the certain steps and the guidelines for applying the method, and also discuss why and how those guidelines should be adjusted if the method is about to become a standard in ecosystem accounts. Then I will present some more practical notes about the method implementation that I think that can be relevant for people that they think to use the method in the future. And then conclude with a justification of the use of method in ecosystem accounts, some future developments and the next steps that needs to be taken, and some take-home messages as a concluding note. So this method that is commonly used in cases that there's no time and financial resources to conduct a primary evaluation. Sorry. So what it is the method about is that we use pre-existing information from previous studies that are collected from one or more sites or policy contexts to evaluate estimates of other sites or policy context. And it's a method that has been recognized already during the 90s by the United States Environmental Protection Agency and was used for regulatory purposes. In environmental economics, it's a very well-known method called benefit transfer method. And I will explain in the next slide why I changed the terminology. So in environmental economics, the method is called benefit transfer method. It is commonly used in large-scale application of usually of benefit cost analysis exercises. So under the SEEA framework, why this method is a method that needs to be considered? First of all, I would just say a very basic argument here that and that comes from the progress that we have so far in the ecosystem accounts. And what we see as of now is that this progress is quite slow still. So we have countries that they are about to start compiling all those ecosystem accounts, but usually they don't have the data and the sources or the capacity to do so. And it seems that a good solution in this phase is that we start with information that we already have. And this is where this transfer of values comes in. And the transfer of values in both physical as well as monetary metrics. So I'm not referring only to transfer of value of monetary values. It can be used also for physical values. In the current SEEA framework, the framework that is typically applied is not a method that is suggested. And this is mainly because this method incorporates values from a set of different evaluation methods. Also, as Alejandro said before, from methods that they elicit welfare values instead of exchange values. So for this reason, is a method that can encompass a lot of different values, and that's problematic because of the compatibility issues between the compatibility issues of exchange value, given the exchange value concept. Though in the latest SEEA revision, the method is mentioned under chapter 9.5.1, and there is a change in terminology here, and that's why I'm saying that I was about to note it down, that although in environmental economics we use the term benefit transfer, in the SEEA revised version, the term that was used was value generalization. So we're talking about value transfer terms in order to reflect this value generalization. And I will continue using that term instead. So we have two main approaches, in generally speaking. We have the unit value transfer. So we take one value from one single study and we transfer it to the site or the policy of the policy context of interest. And it can be also adjusted given income differences or currency differences. And the next more elaborated approach is a function value approach, which can be used either a single site function transfer, so one function that is borrowed from one paper, from one primary study, and get a value using that one function, or a more elaborated one using a set of prior studies, a set of values, and then using statistical analysis, run a meta-regression analysis, and conclude with a function during this process, which is called the meta-analysis value transfer. There are certain past applications of different purposes. I think many of you know the work by Costanza and Toll that have been used, the unit value transfer, to value all ecosystem services at global scale. A more recent one that Soeli has shared with me is a unit value transfer for the EU Marine Strategy Program to achieve good environmental status. And at the end of the presentation, I am providing all these references for those that want to go through that. And then we have also a lot of studies that they have applied meta-analysis value transfers for certain ecosystem or certain ecosystem services. But there are no studies that they have applied the method under the ecosystem accounting context. This is what we miss. I am also noted here a work of mine with Davina Vatskarova. We tried to evaluate the forest ecosystem services, and we tried to see how the method would be applied in ecosystem accounts and how the supply and use tables could be compiled using the method. So for those interested, I'm also providing this reference. So the guidelines, they're nicely summarized in Johnson et al. Work and Boylan parameter work. And there are 10 steps that need to be taken. And the first 4 steps refer to the preparation of the work. And in the preparation stage, you need to define what is the policy context of the work, why there is a need to apply a value transfer, because as we will say at the end of the presentation, a value transfer is always a second best option if compared to a primary evaluation. So whether there's a need indeed to apply the method, that needs to be clarified. We need to define the good to be valued and the affected population, and also what is the baseline situation, the current conditions, because whatever we value the change. So we need to know how the change will be made from a baseline condition to a better state. And then on the implementation phase, we have, again, 4 steps. The first step is to gather the studies and to assess the studies and get information, select which approach needs to be undertaken, implement the transfer, aggregate the values, and then conduct what we call a sensitivity analysis to see whether the estimates we get are reliable or not. And finally, report the results. These are the official steps mentioned in the literature. Now, those guidelines are quite well specified, but when it comes to accounts, we think that there are certain gaps there, and there are certain questions, relevant questions, that I report here in these slides that need to be accounted for if that method would be a good idea to be used, if that method would be a good standard in ecosystem accounts. So one important question is the policy context, and I think David later on will explain more about it. I will just share with you his one of the figure. I think he's gonna use the same figure. But what this figure says is that the purposes of the policy context of the evaluation, it actually determines a lot the evaluation methods to be used, because the purpose and the scale of the evaluation will determine actually the accuracy of the estimates. So if for example, we say that ecosystem accounts lies under this tier 1 phase, where we want to show the relative importance of ecosystem service in the society, and we want to do that on the national scale, then maybe a benefit transfer method could be a method that can be applied for that purpose. And of course, then we need also to think of the values that need to be accounted under the value transfer approach. But if the purpose would be a cost-benefit analysis or a policy design where welfare values should be accounted for, then the method should be changed accordingly. So one question is the policy context. What is the purpose of the accounts? Then it's important to understand that we talk about ecosystem and certain ecosystem services, ecosystem accounts. And there is a certain scope and a certain scale of changes that can be either marginal or non-marginal under accounting context. That is important also to be considered under these guidelines. The type of value transfer method is another important question that needs to be discussed under the context of ecosystem accounts. And then there are more practical questions referring to how the primary studies would be selected, how the database should be compiled, given that the accounting framework is a more specific framework than a general evaluation exercise. Then how do we measure accuracy, and what is the accepted range of accuracy level that can be accepted in accounts? And also, given that the accounts should be reproduced every year or more than a year, so it's a periodic exercise, what sort of requirements should be accounted there? So those are questions that should be considered. And those questions conclude to a certain challenge. So if we say that we need to adjust this framework of the value transfer, then certain challenges arise that need to be addressed. And all this information that I presented this slide are discussed in detail in a work of mine with great peers. Alejandro is among those, and David is among those peers. It's a paper we have presented in ERE last year, and there we've discussed all these challenges and how we address all these challenges if we assume that this method is something that we should suggest using in ecosystem accounts. So the first 3 challenges are challenges that are faced during the preparation phase. And this the first one is about matching the physical metrics with monetary metrics, because of course when we talk about accounts, we talk about first we start with the physical data, and later those data are translated in monetary metrics. And in some cases, the spatial resolution between these two metrics are different. So there is a mismatch that needs to be accounted for. Next is the exchange versus welfare measures that Alejandro also discussed before, how to overcome this problem, given that in many primary studies, the values are expressed in welfare terms. And the third one is about spatial factors, because spatial factors affect physical and monetary metrics. If you think how the extent and condition accounts affects the flow of ecosystem services of a certain ecosystem, and also if you think how distance affect the value of prices in the economic part of the ecosystem accounts, then this is something that needs to be accounted for during the value transfer preparation. And also it's a temporal variation, because as we said, accounts are periodic exercises. So whatever value we transfer is not a value that can be taken every year. Values should be adjusted to time. And the next one, the next set of challenges refer to how the method should be applied. And here we talk about how the studies should be selected, because a good value transfer depends on how well how good you do in terms of selecting the good studies, and how you organize the information. And later on, I will note here how challenging that can be in terms of how you compile and you organize diverse information to compile a database. And another important issue is the transfer error. So what is the difference between the values you transfer from primary studies from the true values? And there are two dimensions here that reflect to accuracy, is the validity and the reliability dimensions. And although we have a lot of information from literature about what is the level of those transfer errors given a different value transfer approaches, we don't really know what should be accepted in ecosystem accounting purposes. And the last one is the periodicity of accounts. So if we think of the fact that accounts need to be compiled every year or every second year, then what sort of method and what sort of requirements we should address here in order to achieve this. So all these are challenges that need to be addressed and need to be incorporated in a new framework, in new guidelines, if the value transfer method is to be used in ecosystem accounting. In practice, for those that they are interested to start thinking about this method, there are open databases and data sets that report already values that can be used for value transfer. I report here two examples. One is the Ecosystem Service Value Evaluation Database. The other is the Environmental Valuation Reference Inventory. So there is organized information there to collect information of values. Then, as I said, another important step in the evaluation process is the selection of studies. And of course, a review is demanded. And what is important here is that a systematic review is acquired in order to have a more systematic way of revising the primary studies. And the systematic review is a stepwise methodology of synthesizing research data, starting from the right keyword selection to abstract and title screening to full text screening, and finally to data extraction and assessment of the final studies based on certain qualitative criteria. And I report here an example of a research study that they have applied the systematic review on monetary valuation methods to support marine management. And as I said previously, one of the key challenges in employing the value transfer methods is to organize information, to compile those data sets, because in most of the cases, primary studies report information in a very heterogeneous way. in a very different. I mean, you can even have differences in the way that ecosystem services are classified, or in terms of the units. So you need to be very clear in how you will define your clarify your information. You define your information, because in some cases it's going to be needed to do some sort of transformations, and those data set needs to be very well thought and designed in order to accommodate all these differences from primary studies, and this is not an easy job to do. And then the meta-analysis, and I mentioned here the meta-analysis because I think this is a good suggestion when it comes to ecosystem accounts, because it's a method that can solve the problem of the periodicity of account, because it can offer a model, a tool in the hands of practitioners that can use every year to estimate values. It's an elaborated method. It's not an easy method. You need a lot of data. You need a very clear model specification and econometric analysis. And I report here a very simple example of a linear specification. For example, you have an Y value of a service that is reported in US dollars per hectare per year. That depends, a function of several factors, starting from socioeconomic characteristics to biome and ecosystem service valuation characteristics. A lot of different factors in the function that should be accounted for. And of course, a very important part of this process is the evaluation of transfer errors, as we said before. What is the difference between the transfer and the true observation value? So I will close my presentation by saying why we suggest the use of value transfer method in ecosystem accounts. First of all, it's something that we already do. We know that. You can think of, for example, the carbon sequestration data and how we use this lookup table approach to evaluate the flow of the service in different ecosystems assets. This is a transfer of physical metrics from the literature. And other examples are unit value transfer for valuing certain ecosystem services. So it's a process that we already do in accounts. It's a pragmatic approach. It's very cost effective. So countries that they are starting now, they can use a method to gain experience and to accelerate a bit the process of getting acquainted with a framework. And another important aspect is that it can accommodate both exchange and value concept. And I think this is also relevant to what Bram said about the complementarity presentation. So that method can provide that information for the complementary presentations. And last is the fact of the periodic characteristic of accounts, that the value transfer method allow this periodicity to happen. And this is quite important and again pragmatic for the statisticians. The future developments, what is the next steps to be followed? And again, I mentioned here that this is something to be considered as a second best approach. So we need, first of all, to adjust the guidelines to the accounting purposes. Next, we need to standardize procedures for primary studies, the way that we report primary studies, because this is not there yet, and also a standardized procedure of how to compile all this information and to build a database in a homogeneous way. Then we miss recommendations for acceptable transfer errors. As Alejandro said, what we would expect in the future is to see more specially explicit value transfer applications. Next would be to see how value transfer outcomes in welfare values can be translated in exchange values using the simulated exchange method. And the last is that meta-analysis functions and models in that terms, how those models can be used in periodic accounts, so for more than a year. What needs to be done there in order for those models to be replicable? And I will close my presentation with some take-home messages. Yes, we can use this method because it can accelerate the empirical applications, especially at the national scale. We already know that. It's a low-cost solution and it's SNA compatible, meaning that we can account for these exchange-based values in the application of the method. It's a transparent approach for periodic accounts. Of course, we need to have in mind that it's less reliable than primary surveys and needs to be accounted as a second-best approach only for this transitory phase and only at this phase of starting the accounts in the experimental phase. There are certain challenges there that should be acknowledged in current applications and should be addressed. And in this respect, I think that it would be important to have a close collaboration between the two disciplines, between value transfer experts from environmental economics disciplines and ecosystem accounting experts that could combine information and help us go further. Those are the references from the presentation that can be of interest your interest. And before I close, I would like to just share this with you. We host a session in the next Ecosystem Services Partnerships Conference in Tartu. And this is about empirical applications in the national capital and the development of national capital accounts. And we look for speakers. So if any of you have something interesting to present, just let me know, because we can help out with your presence there. And thank you very much. Questions or comments are very much welcome.
Okay, thank you, Joanna. We do have a couple of questions, and I think I put them on the slide, so I think it's easier to read. And at this point, it seems that most of them are for Alejandro. So I just try to share the screen so you can easier.
Yes, I am trying to. Yeah.
Okay. Can you confirm what do you see? Because now I kind of lost. Do you see the questions?
Yes, but you would need to make it enlarge it a little bit, maybe make it.
Okay, yeah, okay. Yeah, so there was like a first question related to restoration cost. And I think it's easier for you to, yeah,
whether the restoration costs are larger, well, yes, maybe, but the restoration costs need to be a willingness to pay, and that's not always obvious. On the contrary, where we are comparing apples with oranges, I'm not sure in the case of restoration cost. If you use the transport price, so people really paid that. So if we just reallocate like consumer expenditure, you're just reallocating in GDP, saying that can be attributed to an interest in the nature. So this is not increasing GDP. And if you want to increase GDP, so obtain a value that is bigger than the GDP that we have, because the environment has been taken into account, you would need simulated exchange values, where I would argue that it is more apples with apples if you do this than if you do replacement cost. Because basically it is how much would you be willing to pay in a market for real. Actually, the replacement cost, it is okay if you also would need to have a demand to really know whether people would be willing to pay that amount. Once you have the demand, you need a travel cost method or a choice experiment or whatever to have the demand. Once you have a demand, both methods are actually quite similar, because the replacement cost simply say you, okay, this is how much people would be willing to pay, but now I need to pay if they really would be willing to pay it. So then actually they're kind of converging, because once replacement cost, you really do all the steps that are supposed to be done, which includes proving that people are really willing to pay that, then it gets quite close. And then the values cannot be very different, because in one framework we are asking, how much are you willing to pay for this, for real? And imagine, and then I say, what is the market structure? It's going to be a monopoly or perfect competition, whatever. And that is my best estimation of what would happen if we really internalize this product. For example, free access recreation. Replacement cost for the recreation activity. If I really take into account that it has to be within the willingness to pay of people is actually quite similar. So there will not be huge differences. When there are huge differences, this is when I would argue that the replacement cost is not properly done, because it didn't take into account the willingness to pay of people. Then, of course, it can go to infinity, because in some places, replacement costs go to infinity, because it's almost impossible to reproduce what we have with man-made inputs. But then you are definitely not having an exchange value. So if both really measure exchange values, I would say they go very closely. So that would be my answer.
Okay, so then we go towards travel costs.
So yeah, travel costs very related on COVID. Yes, of course, the same than GDP. So national accounts are very related to COVID. COVID, as soon as you stop exchanges, GDP dropped. If you go in GDP dropped last year a lot. Of course, if you have the same way of measuring of the national accounts and you extend it to the environment, those years where travel to the recreational areas drops, it will drop as well. So the assets is different, because the assets is a long-term thing, and then it will smooth out. But for one particular year, yes, GDP drops. We have seen it has dropped 10, 15%. The same would have happened if you would apply this in any of these methods to recreational use, because simply it is a true fact of life that in 2020, people came less or more. First, for a few months, they came less to nature because they were locked down in their houses. And then in the last part, they actually went more to nature because they felt safer there. That happened for real. Accounts should record what happened. So it's absolutely no problem if it's affected by things like COVID. I mean, it's no problem. It is no problem in the sense that that's what accounts are supposed to do, react to these kind of things. That's what they do, GDP. That's what ecosystem accounting should do. So if you don't have data to estimate the demand function, it's okay to use consumer expenditures of travel costs. With consumer expenditures, you will only get what is already in GDP. You're reallocating, saying this part, I can explain it by an interest to go visit nature, but it's the same in GDP. You would not have any in addition. To have something in addition, you need a demand function, and then you can have the simulated exchange value. But the thing is, the data are very similar. So what I tried to explain before, maybe I didn't have enough time to do it in detail, but actually the data are almost the same, because once you have the travel expenditure data, what people spend, you simply add the assumption that those who came 100 times to the national parks because they lived just next by, I say, if they would have, because I know that people living far away come only 10 times, I can say for the first 10 times, those people living next by would have been willing to pay much more. Because I know that people living further away, they actually come a few times, not 100 times, but they come 10 times a year or 1 time a year. So I use this information. And once you have the information to do the consumer expenditure, you have the information to do a zonal travel cost at least. You just need to know where people came from. So this information you will have. So it's actually a marginal extra input to do a travel cost to estimate the demand, travel cost method. And once you have the demand, it's again, marginal change to do a simulated exchange value using that demand that you have estimated. What travel costs were specifically considered to calculate the demand curve? Well, I didn't go into that detail, but this is in generally, well, there's a lot of debate on that. There's a lot of debate in the travel cost literature, what you should integrate and what not. It is quite clear that marginal expenses, so the last bit that you're expending, is quite clear. So, for example, if you take your car and you go there, the gasoline or the petrol, you will definitely have to account for. Whether you have to take into account the depreciation of the car is something where is more debate. Because most people, when they take a marginal decision to go to a park, they don't take into account the depreciation of the car. So probably you should not take into account the depreciation of the car. Yes, the marginal expenditures. The hardest bit becomes how to estimate the time that you spend traveling. Because when explaining why people living close by come 10 times and people living far away can only 1 time, is not only that you have to pay more for gasoline, it's also that you will be sitting for 3 hours in the car. People don't like that. So ideally, we would need to value time, and that's very difficult. For that, there's a long debate on that as well. That's why I also suggested before that it would actually be good to do travel costs to estimate the demand, but also a content evaluation. You can estimate the demand with both methods and see whether these 2 methods converge. This is convergent validity is called. And that's of course reassures you that you're doing it properly. Because with the travel cost method, the big problem is to value time. That's very hard, and that's why that's the weakest part for the value the time. But it's an important part. Of course, again, accounting is about being prudent, about being conservative, and then maybe it's good to have a first estimate without any value of time. This can be done, and for that you don't need additional information. As I said, as soon as you have the information for the consumer expenditure, you make the strong assumption that time has no value, and you have a first estimate. It will be a conservative estimate, but it will give you already a demand function with which you can apply the simulated exchange value and have a value which is exchange value, hypothetical exchange value, but an exchange value that, as Bram said at the beginning, what people would be willing to pay could be exchanged at this price. So you're trying to estimate at the price that it could be exchanged, not the one that it was exchanged. But I think it's good approximation. Any other?
Yes, we do have. Let's have a quickly through these questions, and then we need to stop and have a break, and I will prepare or collect the rest of the questions.
Okay, could a simulated exchange value be the lower bound of the willingness to pay estimate? Well, it is always smaller by definition than the consumer surplus, because it's only a part of the area under the demand function. So yes, it is always going to be smaller. So it is smaller or equal. So it's always going to be smaller. In that sense, can be considered the lower bound. But it measures different things. So it is related, but it measures different things. One is all that people would be willing to pay, in addition to what we're really paying, consumer surplus. The other one is how much they would really be paying in a market with the best market structure that we can imagine for this area, with the most appropriate market structure, either monopolistic competition, perfect competition, whatever it is. So they measure different things, but yes, they're very related in the sense that it's always going to be a more conservative estimate, the simulated exchange value, and it's going to be more robust because it doesn't depend on what happens at the end of the demand curve. The problem with the consumer surplus, exchange variation, whatever it is that the part where the demand function comes close to zero can tend to infinity, and then your value can tend to infinity. The simulated exchange value will never tend to infinity. Willingness to pay can tend to infinity. So, so the next question, by the way, that's not the case. Well, it's much more related, of course, than what is the consumer expenditure, because as I shown before, the other one is not related to willingness to pay. So to get an exchange value, we have to assume that there is a well-defined owner of the ecosystems that would supply the ecosystem service to the market. Yes, that would be the idea. So you do it either it's a well-defined owner, which can of course be the ecosystem trustee. So for public goods, it can be the ecosystem trustee. When we define if you say that you set up a payment for ecosystem service to protect biodiversity, threatened biodiversity, it must be this ecosystem trustee we called it in our applications, and then one in Andalusia, we called it the government. Well, the SEEA has decided it's not the government, it's ecosystem trustee, but that's fine, it's the same idea. So you have society more or less representing this ecosystem, what does not have a precise owner. So because in the current, as Bram said before, if we simply stay to the current institutional framework, well, the price is zero. If we just do the cost, the price is again zero. We have to do something different. And then we have the best institutional framework that we can, the most adapted, but not absolutely the current one where the price is zero. So is this a resource rent? Yes, if we take out all the man-made inputs. In the application that I presented very briefly from Andalusia, a bit more detail this afternoon, you say this, we estimated how much this ecosystem trustee, the government in our case, actually spent on providing the recreational service. So there was we estimated the demand. We saw how much they could have charged if they would have decided to do it, how much they could have charged all the recreational visitors of Andalusia. And then, but we deducted, of course, how much they spent because of these visits. That means the government spent actually money in cleaning up the forest, in setting up some watering service, etc. So we have a lot of costs involved in providing this service. So if you want to, what we actually did, because we were looking, as you say, for a resource rent, is we use the demand to see how much would be all the output that we could get, the final production, in this case of recreational services, but we have to deduct man-made inputs because it was not all provided by the forest, because we actually had the government, the regional government in that particular case, providing some money in terms of cleaning up, in terms of watering, in terms of there's also higher risk of fire. So you have costs associated to having people visiting. So you have to deduct all these costs to come up with resource. So yes, you can do it.
Okay, I think we need to stop here before.
Thank you very much for the questions.
Yeah, and thank you for the answer. But we need to stop now and have a break. So let's come back 15 past, and we will shorten the discussions then at the end if need be. But let's come back 15 past.
Thanks for inviting me to present in this MAIA evaluation webinar. I'm going to do an example of an application of values transfer in ecosystem accounting. And see page down. Yes, so I'll just do some brief introductions on thinking about value transfer as part of a continuum or a tiered approach of monetary valuation in accounting. I'll briefly revisit the definition of value transfer, a generalization that Jana touched on, and then I'll do something which I was a bit in a doubt. I was either going to present many thumbnails of cases to give a wide range of examples, but I ended up thinking that it would be good to dive into some depth into one application of value transfer, and I picked a very recent study on urban ecosystem accounting by Madhi Harris and colleagues, including Ken Bagstad, who graciously accepted to let me present their study, as well as gave me some comments. And the study is on valuing urban heat island energy use reduction from trees, and also on valuing the combined stormwater sewage treatment reduction service provided by trees. And then I'll finish with some take-home questions about value transfer. So this is just a kind of a meme or an illustration of a point Joanna made in her conclusions, which is that value transfer can be thought about as on a kind of a scale or a tiered stepwise approach moving towards primary valuation studies or the production of statistics for monetary valuation. And so as monetary valuation is standardized and as statistical agencies resource monetary valuation, you could expect to see us moving from left to right. The other thing I wanted to illustrate with this simple graph was that value transfer can start with very low information cost, but also high evaluation transfer or generalization errors. And as you use more and more information from more and more studies, your value transfer error will fall until you actually have primary valuation studies within your accounting area. And I've also illustrated a possible tiering, which would be that unit values transfer is the simplest and cheapest. The international meta-analytic transfer is more expensive, but more leads to greater responsiveness of price, accounting price or marginal value for accounting. So lower error. And if you use domestic value function transfer, that might be more accurate still. But of course, this will depend on whether the values you're sourcing are from an international foreign context or from a domestic context. So there should be another dimension in this graph, which is, are you sourcing your values from outside or inside the accounting area? That doesn't quite come across in this figure, but so I just wanted to conclude that it's this progression towards primary valuation that should be the results of standardizing monetary valuation. Just a very brief visualization of a definition, which Jana touched on. We could think about benefits transfer or value transfer as transferring from one study site to a policy site, and generalization is generalizing a subsample of valuation from a specific ecosystem and the use of that ecosystem to the ecosystem as a whole, using this illustration from the SEEA as a as a way of visualizing it. So to our study from on piloting urban ecosystem accounting for the United States. Thanks once again to Mehdi, Harris, and Ken for letting me talk about this. The highlights of the study, which I won't cover all of them, but just so you have an interest in going to see the study, it covers regulating services, stormwater, and urban heat island mitigation for US cities, thanks to trees. Some highlights of the paper is it's open source code, uses remote sensing and an automated workflow for physical extent, condition, ecosystem service supply use accounts, which is an innovation of this paper. It does quite an extensive job on documenting uncertainty in the analysis across accounts and how that affects if we can detect changes of physical ecosystem services. I'll come back to that because it's related to value transfer. And then it is an example of value transfer and value generalization across the accounting chain, which is where I'll place most of my attention in this presentation. Just another visualization. You saw this graph already with in Joanna's presentation, but it just shows that the context of this study is a very high resolution, but also high scale study of ecosystem services. And it's for the purpose of demonstrating trend detection and the ecosystem service contribution using ecosystem service accounts, and also other purposes like demonstrating the importance of ecosystem services to the dimensions. And it's relevant at the federal level, it's done at the US level, it's done specifically for industry sectors such as sewage, and it's definitely relevant for the individual cities from which the data is compiled. Just a very brief revisit of the two ecosystem services being covered. Remote sensing is used to detect trees in several hundred US cities over a certain size. There's an automatic quantification of the role of rainfall interception and how that reduces sewage treatment costs in combined sewage overflow systems, which is where runoff and sewage combine and then has to be treated. So any reduction in the input to the combined sewage system of runoff can be valued as an ecosystem service. It also looks at the role of trees in cooling the city in terms of evapotranspiration, the temperature reduction, and consequent reduction of building cooling costs in summer. The data is summarized in terms of supply of a land cover unit, and in terms of use, it's aggregated to beneficiaries in terms of industrial and household sectors. And these beneficiaries are the sewage system and also the owners of different kinds of buildings that receive the cooling benefits. So what I did was I just went through the paper's models and selected out the different instances of value transfer or value generalization. This is taken from the paper. And in the case of urban heat island and energy use reduction, I tried to recompile this into a figure showing the causal chain across the accounts. You see at the top, from extent, condition, service to supply and use by beneficiaries. And at the bottom, I tried, and this is kind of the main focus of the presentation, I tried to summarize both the resolution, spatial and temporal resolution of the different accounts, and also in what instances there's value generalization or value transfer. And so we see for urban heat island energy use reduction, it's based on extent and condition accounts of tree canopy cover and the leaf area index and leaf on period. It's using a data on the percentage of impervious surfaces in the city. Two models, one predicts the surface temperature based on tree cover and impervious surfaces, and the other predicts maximum temperature based on surface temperature observation using remote sensing latitude and the building footprint of the city. And then the service is the difference between these two models when you look at the maximum air temperature with and without tree cover. This is combined with building energy use intensity, which gives a savings of energy use per building, and that's valued at an electricity price, and this provides a benefit to the owners. And the two examples of value generalization and value transfer in this case is that the building use and energy use intensity factor is based on extrapolating from the energy use for residential buildings to all buildings, because there's not enough detailed records on the energy use of all building types, only residential. And the value transfer for monetary values is that the average electricity price of 2019 is used from the different states in the accounting for the different cities within the different states. And so the average electricity price of 2019 is used both in the 2011 and 2016 instances of the accounts. So we see that if you summarize then, moving from left to right, the spatial resolution and temporal specificity is higher for the biophysical extent, condition, and service accounts, and it's lower for the monetary part of the accounting. There's also some aspects that haven't been included because the heterogeneity, for example, of health costs due to heat exhaustion, heat exposure are much too high to do this kind of valuation at a national level. The next case, moving right along, is combined stormwater sewage treatment reduction. Again, I just looked at the model chain and took out the instance of value transfer to give you a flavor of the spatial resolution and what kind of monetary value transfer is in play here in this instance or example of regulating services. Again, the same kind of setup from moving from left to right across the accounting chain. In this case, again, the remote sensing interprets tree canopy cover at 2 separate years with leaf on and leaf area index periods. It looks at the daily rainfall events. Then it uses a rainfall interception factor, which is a function of the leaf area index. It computes this only for cities with combined sewage overflow, because those are the only systems in which trees provide this benefit to avoided sewage treatment costs. It makes an assumption about the impervious surface area under trees, because there's no detailed remote sensing data. And then this leads to reduced sewage treatment needs, which is valued at a cost per cubic meter, which is the average for 16 cities. And then this is attributed or used by sewage treatment facilities in the use account. And the value generalizations that are conducted in this case are that there's a homogeneous tree composition, only trees are considered. The degree of imperviousness under tree crowns is the percentage average for the US. There's no differential consideration of the degree to which combined sewage overflow during different rainfall events, and the average sewage treatment cost is the average for 16 cities. And so again, we see that the resolution from going from left to right is higher for the biophysical parts of the accounts and lower for the monetary parts of the accounts, and that the benefits or the value transfer value generalization in monetary terms is using averages. And again, there's some heterogeneity that can't be captured in terms of ecosystem services regarding reduced pollution of water bodies, because you have to describe the combined sewage treatment plants and their systems in detail for each city, which is not possible when you compile at the national level. And also you have regarding flooding, flood prediction, to do this in an automatic routine for a whole country, but at city level resolution has not been possible in this particular paper. So a very interesting and impressive part of the paper is the uncertainty quantification, and here it's illustrated for the energy savings service. That's the combined uncertainty across the extent, condition, and physical supply accounts regarding temperature reduction has been accounted for and computed so that confidence intervals can be compiled. These confidence intervals are multiplied by the, for the physical service, and multiplied by the average price of sewage water treatment, as I said, so it works as a scaling factor. But what we do see here is in this example of this table I show above, where they've computed for a number of different cities, I've only extracted 3, looking at the energy saving service value for 2011, 2016, when they do compute confidence intervals using the data, it's possible to see whether there's a significant trend in the service annual service value between 2 years. And for some cities there is a significant trend, or there's confidence in the trend, and for other cities there isn't. And this is the importance of quantifying transfer error in the case of monetary values, but also error more generally for value generalization in the physical and the monetary accounts, which is a point that Joanna made. So some take-home questions from these 2 very brief examples. I feel like despite having dived into a single case, I had very little time to give it credit. It's an amazing study, and it helps us move forward with large-scale, high-resolution work chain. But some of the questions for further improvement could be regarding making accounting prices reflect spatial patterns of use of ecosystem services by beneficiaries. The point I made in my previous slides was that the value transfers conducted in this case are averages, or they work more like scaling factors, whereas there can be much higher spatially explicit pricing for different kinds of markets, different kinds of physical distributions of users, illustrated here with some examples. Another take-home question would be, do accounting purposes determine the requirements of value transfer? I would argue yes. In some, depending on what kind of value transfer we use, we'll have greater or lesser confidence in the estimates when combining the monetary with the biophysical. In some cases, the value transfer will be so simple that we can only conclude whether the relative ecosystem service importance is large or small, in terms of, do we have big contributions or small contributions? If we can do good confidence interval modeling, combining transfer error for biophysical and monetary together, we can make conclusions about whether there's a trend in the ecosystem service flow between accounting periods, or if there's a change in the asset value over time. That was possible in this study. And further, we can start comparing between cities, for example, or even between sectors within cities. Final point I would like to make or summarize from the case is that we can see quite clearly that there's a precision differential between the biophysical and monetary accounts, which is due to the kind of value generalization that's necessary in monetary accounts versus the high resolution data or higher resolution data that's available for the biophysical parts of the ecosystem accounts, which determines how far along this tiering, tier 1, tier 2, or tier 3 of the purposes of ecosystem accounts we can come. Again, just to emphasize that the costs is also a very important aspect here. Sometimes the cost will not justify the increase in precision. We might want to stay at a more general level and accept transfer errors, but then we also have to accept that we can't use these figures for all kinds of policy application purposes. Summary for take-home messages. The value transfer approach is part of a continuum of methods to generalize from a few observations or a sample to a whole accounting area. So I think that we should think about value transfer in the context of monetary valuation more in general. The purpose of monetary accounts determines the required reliability of the valuation method. Value transfer for accounting often are just scaling constants. So the information added by the monetary valuation might be very small if you're using unit values. Value generalization applies across the accounting chain. So when we think about value transfer or generalization, we should also include how biophysical quantities are generalized when we look at transfer or errors. They're cumulative, and we have to think about that when we use the accounts to detect change in flow or asset value. And also, excuse me. I've switched on an alarm and now I can't get it off. The periodicity of the accounts depends on the speed of change on the ecosystem, the accuracy and sensitivity to change of the methods, so that in this case, for example, even a 4-year period might not be enough to detect a significant change if the value transfer used is maybe unit value or has a large transfer error. So that's the last point. Accounting year-to-year changes at high resolution may also be expensive and not yield significant information for decision support. So we should see value transfer and value generalization in the greater picture of the purpose of accounting and also the cumulative confidence we have in looking across the accounting chain. So thank you very much. I think we went a bit over time, and I'd just like to thank Mehdi Harris and Ken Bagstad again for letting me use their study and providing some comments to the presentation. Thanks.
So, well, hi again. And now I'm going to talk about monetary ecosystem accounts in Spain. More precisely, most of it is what we did in Andalusia. So I'm not covering all things that have been done in Spain. We're going to focus more on what we've done, mainly in Andalusia, and what we are doing for the whole of Spain. So as Lars said at the beginning, we have been working on this before this existed. So the first publication here, 2003, is the first time we published our authority accounting system. 2003, actually, it was coming out of my PhD thesis, which was published in 2001. So it's very old. And basically, to see how stubborn we are, we're basically using the same kind of methodology and applying it to Andalusia 10 years later, and still publishing on that issue in 2020. So basically, it is not going to be a SEEA application because it's much before SEEA, 2010 application. But basically, what I'm going to argue is that our application is completely in line with SEEA because we did something very similar, which is completely in line with what SEEA has finally done, with some minor differences, but we're really very small. We also have some papers. There's one, I will give citations at the end in 2020, comparing our approach with SEEA and saying the minor differences that we have. We have this publication and a few others. So the bulk of my presentation will be focused on what is the Recommand project, which concluded a few years ago, and was a large-scale application into Andalusia, which is a region of Spain, and where we did an ecosystem accounting for 2010, an ecosystem accounting for the forests in Andalusia, for forest and pastures. So we only left out water and urban, and we covered everything. This has been published in 2019, a long list of co-authors, but the three of us are kind of first author officially. So, but now in MAIA, we are doing the same kind of thing, now at the national scale, but not to all kind of things that are applied in Andalusia, only to a subset, focusing basically on recreation, biodiversity. Simulated exchange values is more our focus now. And well, we have done it for continual evaluation. We have done it for choice experiments. Now we're going to do it at the national scale. Before we didn't do it at national scale. It was in a region in Andalusia, which is actually a very large region. So it's like Austria, something like that. So the agroforestry accounting system, I will argue is simply as it's one particular way of doing the SEEA. So it focuses on the economic activities and products in that particular territory. So it is spatially explicit from the beginning. We take into account private and public outputs and costs are considered. We focus on net value added in income for each activity. So we give it for each activity. That's one of the main differences. For each activity, whether it's recreation, whatever it is, you have all net value added estimations and income estimations, which we think is interesting for payment for ecosystem services, for example. So we focus a little bit more than SEEA on intermediate services. And the big difference, I will argue, is that our either environmental income, which is only the contribution of nature, or our total income concept, which would be man-made plus nature, includes capital gains. So basically we're doing Higgsian income. But as Bram said before, SEEA can do Higgsian income because it has all the information to do Higgsian income. It's just a question whether you consider the capital gains should be included or not. So we have manufactured and environmental values, and we have them for flows, prices times quantities, what happens in a particular year, in our case in the application 2010, and capital values, which are market prices of future discounted capital income flows, basically net present value of future flows. We have for commercial products and for non-commercial products, so those which are traded and those which are not traded, we distinguish the manufactured and environmental part. So that's why it's not a mistake what is in the bottom and the top. It's actually that for commercial products and for non-commercial products, there's always a man-made part. So if you have public recreation, as I said 1 hour ago, there is a part which is actually man-made, which is the cleaning costs associated, etc. We distinguish always this environmental part from the manufactured part. Within the commercial products, what we work with, we have timber, it's forest. Our main is of course forest and grass. So we have cork. In our area, cork is very important. It's a bit more complex than timber. We have grass and acorn. We have game. So we also measure game. We have mushroom picking. We include livestock, but only at the micro scale, not for the whole of Andalusia. It's a little bit different. And then for non-commercial products, we have public recreation, private owner's amenities, which is basically the recreation of the owner, that he can use his land to go with friends walking around or hunting or whatever. We value forest landscape and threatened biodiversity. We do it together in our choice experiments because they're very interlinked. We thought that adding one after the other one be maybe double counting. So we do one choice experiment for both. We have carbon sequestration and some minor things. So our forest accounting system, very related. I'm not going to go into the details. We have a production account, total output, including SNA outputs and non-SNA forest outputs. So we have the manufactured part, what is already in SNA and what is not in SNA. Total cost the same, those in SNA and those outside. Capital balance, we will have what we call work in progress, but it's basically the inventories of the current SEEA, and we have fixed capital, where we have biological resources and part of it we attribute to land. So basically work in progress is what we have right now. Fixed capital is what we will have in the future. So very important for us, the simulated exchange value that I mentioned before. We estimate a hypothetical market, for example, for recreation, as I said before. And now we said how much is the value that I could internalize? How much could I really charge under a certain number of assumptions? Monopolistic competition in our case, because we focus on iconic recreational sites. How much could I really internalize? And then I will bring this into my account with a simulated price. I could do something similar, as I said, for maintaining the number of threatened species as this as a service. And now I can set up a market for a payment for ecosystem service. Again, I will have a demand. I see how much I can bring into this. I could internalize how much I could make people pay for that. But let's keep now recreation for an idea. So if we go back to our recreation example, we have internalized now put to the left is the maximum that we think that would be obtained if it would really be marketed. So is the else what we said at the beginning, what Bram said at the beginning, else could be exchanged for cash, could be exchanged. It is not exchanged, but it could be exchanged for cash. This blue area is the maximum, is our best estimate of what you could obtain if you would market recreational services in Andalusia. There are, of course, many limitations, but that's our best estimation of that. But we think that if the decision would have been taken to include recreational services in Andalusia so that people have to pay for them, that's the best estimate of how much you could obtain. Then, of course, as I said before, we have to take out labor, manufactured inputs that you have included and all these kind of things that you have produced, as I said, watering costs, cleaning costs, but you have man-made inputs that were provided by the government in most cases, but some cases also by private producers to produce this product or this service, which is a recreational service. And all what is left, that would be our resource rent, if you want, that would be our true ecosystem service, the contribution of nature to the recreational service in Andalusia. Then for timber, what did we do for timber? Well, we simply, it's a net present value. So we have our tree with the growing. we are currently right now here, so we are not planting from zero, we are in the middle. So we need to see what is our inventory, what is our work in progress in our terminology. Inventory for SEEA would be what is left until, so you have to discount until you will cut it in year T. So you're in the middle of the cycle, you're cutting, this is what you consider work in progress, and what it will be the future. This is going to be our fixed capital for timber, what is going to be the future rotations. So the current rotation is work in progress, future rotation we separated as fixed capital. So we have both included, of course, but separated. For current, so basically the standard function, discounting to infinity, but separating the first rotation from the rest of the rotations will come afterwards. And if you want to, we can focus only on production account on the current year. For carbon sequestration, something similar, but here we include entrances as imputed sales and exit as services. Basically, what in the literature is known as carbon flow method. So you take into account what every year comes in, comes out, and you see what the net is. And again, we separate, of course, we do it for the current rotation, and we also take into account in the fixed capital what it's going to be in the future, the carbon sequestration in the future of this, in this particular piece of land. So we do this for each particular piece of land. As I said, main difference with the main SEEA, our method, our forest accounting system with the SEEA, is that we include capital gains. So we include capital gains. In our capital balance, we estimate a capital gain. But as Bram said before, you could do exactly the same thing with SEEA, and it's even proposed as a possible extension. From the production account, we obtain net value added, that you can do also with the SEEA, and we add the capital value to obtain our total social income, which includes the private part, which is the forest owner, what the private owner gets, and also what in our case, we call it public or government, but in SEEA it would be the trustee. What the trustee is, so for example, we say that the trustee would get this biodiversity benefits, or this trustee would get the free access recreation where no one is really getting this money. So we have this trustee concept, we called it government before it was before, but now it has been adapted to trustee. It's the same basic idea. And then out of this total social income, which includes the environmental part plus the man-made part, is the total, what is really traded in markets, is what we call total environmental income, which is of course a subset of that. For the net value added, we can do the same, we can separate it. So our application, where was it? It was in the south of Spain, very big area. So all the problems that you have in a national application, so say size of Austria roughly. So 4.7 million hectares of montage, which includes everything, as I said before, except water surfaces and urban. Andalusia, data for 2010, and everything is spatially explicit. So values are obtained, as we said before, when my presentation, directly from markets. When you can, for timber, for cork, we don't do anything weird. We go to the market. We just have the problem to put it spatially explicit, because that's not easy to see where the transaction actually took place. A lot of effort, but it can be done. From all existing market, carbon sequestration, what we did, we went to the emission trading system in Europe to put a price, estimating from the literature how much the price would be reduced if forest would be included in the system, which is not right now. Private amenities, there we did for what people are willing to pay to keep the extra for keeping the property what the thing is in Andalusia and everywhere. People are willing to pay more for a piece of land than what they would get out commercially, simply because they enjoy being there with friends, going with family. We try to estimate that. For forest water, with something similar. Mushroom gathering, well, I cannot go into all the details in 20 minutes. By simulating, these are all existing markets, basically. For simulating markets, we did it for public recreation, we did it for threatened biodiversity and landscape conservation, as I already mentioned, continuing evaluation in the first case, and choice experiment in the second. As you can see on the right-hand side, we used all kinds of data. So we had forest national inventory, of course, a lot of transactions we really observed. We went in depth into a number of the states. We have interviews to hunters, to mushroom gatherers, to free access visitors, to households, all kinds of interviews done to obtain this information. There was also a measurement of the biodiversity, a measurement of clean water consumption, hydrologists, biologists, a lot of people working together on this project. So at the end, what we obtain? Well, we obtain environmental incomes, not many more indicators, but this is our main indicator, which is the environmental income, as I said, including capital gains in this particular case, the environmental part, the contribution of nature to the income, to the total social income, which would be the environmental part plus the commercial timber, for example. That's if you want the total. Here we have this for timber, cork, firewood, nuts, grazing, hunting, private amenity, public recreation, mushrooms, carbon, landscape, biodiversity, water, and all parts together. So we can add them all together. Because they are exchange values, we did our best to have exchange values in all cases, so we can add them up together. So you can have the last figure, which simply adds all these environmental incomes together by the different products obtained. So, and then you can also obtain, of course, the ecosystem service. Defined, as we said, the contribution of nature now only. In this case, there is no capital gain anymore, because in ecosystem service, there is no capital gain. So you can take this estimation as well. Again, you can add them all together because they're exchange values, and that's what we did in this particular graph here. If you're interested in that, there are two places where you can check it out. So there is first the VCAF, we called it. This is then a web-based viewer done by FESIC and in collaboration with the Junta de Andalucía, which is the government who paid for that. In Spain, it's very important to say that the management of natural resources is in the hands of what we call autonomous communities. So the region manages natural resources. So that's why the government is not so interested in these results. The part that is really interested is the regional government. And they paid for the study. And they are now hosting, and very recently, but we're very proud to say that now it's an open access. You can access this, and it's hosted at the governmental webpage. So they really, they're not only using it internally, so now they're really publishing it and making it available for everyone. This has a lot of detail. I will go in a minute into that. But we did a subset of this information. We took it out and we included it into the MAIA analytical tool, which is in the MAIA project. We are encouraging different studies to be integrated into one tool for all of Europe. And here we integrated a subset of the information available in our VCAF, has been integrated in this MAIA analytical tool, which has advantage that you can compare it over all of Europe. You can go everywhere with the same analytical tool, and it's also very user-friendly and allows you to do a lot of things. That's why we don't call it a viewer, we call it an analytical tool. So I said the VCAF, here is the Agencia Medio Ambiente y Agua. This is the branch of in charge of the environment and water at the equivalent to the Ministry of the Environment in the region of Andalusia. So this is an official agency which produces other statistics as well. And now they have put up openly access. You can this viewer. And here you have access at the viewer, and you also have access to the production of accounts. Our system produces an account for all of Andalusia, but it also produces your own account for a sub-area. So if you select one particular area, you not get only the viewer, you also get the accounts with all the information that I said before. Maybe we have 1 minute. We could try to go live. I don't know if you see it. Do you see now where I went into the webpage? Do you see it, Soile?
No, I think I still see your presentation.
No, so let's see if I could do it, how I could do it. I have to stop sharing and share again, I guess. So now you see that? You see the viewer now?
Yes.
Okay, so you simply select a particular area. This is one region there. Then you go into indicators. You have physical indicators, commercial activities, or environmental activities. More interesting for us, maybe the economic indicators. You have private activities, commercial, environmental activities, your long list, private amenities, free access recreation, mushroom. Then you go, for example, in public recreation services. And here you have to select one of the many indicators that you have: total income, which would be everything, environmental capital income, net operating margin, and the value added. You can have this spatially explicit. All of these accounts become spatially explicit, and you simply select, and it will display you. It will take a little bit of time. It will show you what you are interested in. So you can have this here, and you can also, let's stop it, go to the accounts, and it will produce you an account for the region that you select. It will tell you that you have to select what you want, the production or capital account, or the level of social, private, or public, what do you want, the extension that you look for all of Andalusia for one of the regions, and whether you want it for all types of forest or only one particular Pinus silvestris, for example, and it produces you in this case, the account for the province of Almeria, Pinus silvestris only. You have production, intermediate production, final production. You have all the information available here. So this is kind of what you could have once this system works. And I think it for us shows that there's a lot of things that you can do with this. And as I said, we have done a simplified version and the MAIA portal analytical tool, where we have also by age and social, government and private. By indicator, we have included only 4. Instead of the list of 20 that we have in our VCAF, which is a bit confusing, we decided to go for net operating margin, net value added income, which is Hicksian income in our case, includes capital gains, and ecosystem asset. So basically, of course, net income is basically the net value added plus the capital gain. The ecosystem asset is doing discounting in from the future, all the future flows, while the other ones, net operating margin, net value added, and income, are year to year, in particular 2010 in our application. So what's new in MAIA? This is an old project. Well, first, we have been working a lot inside MAIA, comparing our approach to the SEEA approach. SEEA, it has been a little bit difficult because the SEEA has been evolving all these years, so we had to change the different, but basically the main part of SEEA has remained constant. So we have published a number of papers now trying to explain what relates both systems, and of course, if there's anything that can be learned from our system for SEEA, we are more than happy, so we explain it also. So now we're doing simulated exchange values at national scale for threatened biodiversity, possibly landscape or condition. We're distinguishing how threatened biodiversity is. In our previous application, Andalusia, it was just all threatened biodiversity was treated equally. Now we will try to see whether there's a higher willingness to pay for the species which are more threatened than others. We are working on that part. Basically, it's the same idea. Total income of the primary ecosystem service that would be obtained if implemented. Again, this is not yet the application for the whole of Spain. It's not available yet. It was a choice experiment in Andalusia, what we did. And then, as I already explained in the previous presentation, basically what we do is we see how much people would be paying for this. And then we obtain different simulation values, and we see where you would obtain the largest revenue. Then with constant cost would be the point that we would select. If constant costs are not constant, then you would need to take this into account as well, in addition to the market structure. You can do this. Now we are focused, we have done it in the past mainly with contingent evaluation. This time we are focusing more on using choice experiments, although we did it already before as well, but not at the scale that we are doing it this time. So here are the references that I have been using, and well, that's all I wanted to talk today. So thank you very much for your attention.
Okay, thank you, Alejandro. We do have 2 more minutes, and we do have 2 questions remaining. So I will share the questions so you can see them. Now I will open it up. I think we have one question for Joanna. Well, she already responded in chat, but I think this is an interesting point. So, Joanna, do you want to comment on this?
Yes, thank you, Soile. As you said, I have already responded to that, but there are 2 important points that I would like to make here. One is when we talk about standardized procedures, we talk about 2 things. One is a standardized procedure of the way that the primary studies, primary valuation studies are reported, because as we know, there's a lot of heterogeneity in that respect, and that makes the work of value transfer very, very difficult and also questionable. So we need to know that there is a certain procedure that future primary studies need to be followed in order to report in a certain way their outcomes. And the second procedure refers to how the review needs to be made. Because again, we know that there is a certain methodology in the literature referring to the systematic review methodology, but not in terms of, not under the context of ecosystem account. So that needs to be revised as well, and that needs to be defined and clarified. And yeah, that goes very much into the way that the data, the information is organized. So how this data set should be in a way structured homogeneously, so that all value transfer methods follow the same sort of procedure.
Okay, thank you. And then last question, and then I think our time is up. So I think this was for Bram, but I think Alejandro can answer, and I think you partly answered this already in your presentation. So perhaps you can explain this once more.
Yes, so basically they're saying that we should not focus on a single ecosystem service, which is completely right. And that's why in our application Andalusia, which I think it's how I would do it, of course, but that's how so you try to put all together into a single accounting system. So you have to make sure that so that you can add them up, all of them. It has to be all exchange value for commercial goods, for commercial and for non-commercial goods. So for timber and for free access recreation, everything has to be exchange values. Then you can add everything together, and you can make nice maps, selecting whether you want an environmental income, total income, net value added, whatever you want to do. As long as you're all in exchange values, you can add it up. And this you can make nice maps, but you can also do accounts. And that's what the big power of this is. You can do accounts. And if you design your study properly, and if you have the capability, you can not only do the accounts at the large level, you can also do it at smaller levels, because you're simply adding up what happens in that particular area. And you can add it up. It's not necessarily only a national scale. You can also do account at smaller scales. But very important not to focus on only one single ecosystem service. That's why the difference with most of the environmental evaluation literature in the last 30, 40 years has been focusing on this one single attribute in most cases. Why is that? Because adding up these values is difficult. You can do it, of course, in a cost-benefit analysis, taking into account Higgsine variations for everything. But then you would also need to take into account Higgsine variations for timber. And no one does a Higgsine variation for timber in general, because you would need to estimate the demand and see how much people are willing to pay for timber. So then this has not been applied very widely to do it with a large number of different ecosystem services. But now within ecosystem accounting, as soon as everything is exchange value, you can add it up. And then that's the big advantage compared to most of the environmental evaluation literature, that you can actually add up things. And what you just said, don't pick only low-hanging fruit, but try to do all of them as far as you can. Thanks for the question.
Okay, thank you. So those were the questions that we had today. And in the agenda, we had promised to give you a synthesis, but as we already passed the time, we will share all the slides as we explained in the chat box. All the information will be available in MAIA portal. So I think it's time to thank you all for participating and all the questions. And thank you also for your presentations.